Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
All right, let's dive right in. We're looking at a really fascinating situation unfolding in the aerospace sector. It's a story of extreme asymmetric volatility. You have this massive, high-stakes government defense mandate on one side, and it's just colliding head-on with an incredibly fragile, almost distressed capital structure. We're talking, of course, about SIDU, SIDU. The trading activity just this week has been, well, explosive. After closing yesterday around $3.25 on huge volume, it's holding strong, sitting around $3.37 after hours.
And that price action, it's almost purely speculative velocity. The market is just pricing an immediate, violent short squeeze. It's not pricing in any kind of structural integrity. The technical environment here is defined by a really high short interest. It's getting close to 15% of the flow. And crucially, the cost to borrow rates have just spiked to, an alarming 136.14%. That kind of setup, that friction, it guarantees one thing, a massive move, up or down.
And that's exactly what sets up our central question today. Is the company's valuation right now fundamentally justified by the forward-looking potential of that massive $151 billion Shield IDIQ contract and all the short squeeze mechanics that come with it? Or is all that potential upside just fatally constrained by the massive dilution and the warrant overhang from their recent financing?
Well, I'm going to be arguing that the structural risks, you have the $1.50 institutional offering price and the $2.25 warrant strike, they create a kind of perpetual liquidity wall. This supply ceiling, it just acts as an insurmountable cap on any kind of sustained rally, no matter how good the contracts look on paper.
And I'm taking the other side of that. I think the Golden Dome defense narrative, when you couple that with the unique military background and the tech, it fundamentally overrides those immediate balance sheet concerns. This setup creates an asymmetric opportunity where the upside just vastly outweighs the downside risk that's anchored to that offering price. I see why you're focused on the risk in that offering, but we really have to frame this company outside of a typical financial analysis. SIDU isn't trading on its past anymore. If you look at the numbers, Q3 2025 revenue was down 31% year over year to $1.3 million. But that's the old business model. The market has completely repositioned SIDU as a high beta play on proliferated low Earth orbit constellations. It's a key beneficiary of the DoD's Golden Dome initiative now.
That repositioning is just pure speculation, though. It's a narrative that conveniently ignores the business reality that came right before it.
But that narrative is backed by some very real operational milestones. The $16.2 million they raised in December, yes, at that $150 price, was absolutely critical. It bought them a 12-month cash runway that mitigates the immediate bankruptcy risk, and it lets them pivot to the higher-margin space-as-a-service, or SPAS model. And you can't overlook the credibility of the founder, Carol Craig. She's a former U.S. Navy naval flight officer. That kind of operational know-how, it's a real asset. It just resonates within the DoD procurement world. The people handling these complex contracts like SHIELD. It reduces the execution risk.
Okay, I'll grant you the bankruptcy risk is off the table for now, and the CEO's background is a genuine advantage in this sector. But when we're talking valuation, the math is it's overwhelmingly negative. I'm coming at this from a different angle. The current valuation is completely untethered from reality. We're looking at a price-to-sales ratio of somewhere between 15 and 20 times trailing 12 months revenue.
And why is that multiple a deal breaker?
It's a deal breaker because it values the company like a high-growth software unicorn, not a defense manufacturer that's actually seeing its legacy revenue shrink. Just look at a peer, a stable one, like Redwire. It trades at a very rational 3 to 3.5 times sales, and it's showing consistent 29% growth. SIDU's valuation, it demands exponential growth starting right now, and the capital structure just cannot sustain that kind of pressure.
But Redwire is trading on stable, predictable growth. SIDU is trading on the potential for exponential inflection from a complete business model shift. That's the key distinction.
Exponential inflection is just a nice way of saying hope until you see firm orders. And that public offering, the 10.8 million new shares that fundamentally destabilized the float. The share count expanded by over 1,000%. And more importantly, you have millions of warrants that are exercisable at $2.25. This creates a very real liquidity wall. Anytime the stock trades meaningfully above that 225 strike, the warrant holders have a huge economic incentive to exercise and immediately sell. It's a systematic source of supply that acts as a natural ceiling.
That's an interesting point on the mechanics, but I'd frame it a bit differently. The fact that the stock has held above that warrant strike for any real length of time, it suggests that the short-term demand, fueled by this defense momentum, is just overwhelming that structural overhang for now.
But for how long? I mean, how long can demand outpace that much structural supply? SIDU is stuck in what we call the valley of death right now. The old engineering revenue is declining faster than the new satellite revenue is ramping up. So the stock is basically a coin flip on future funding that realistically might not even show up as recognized revenue until late 2026. That gap gives that speculative premium plenty of time to just evaporate.
Okay, let's pivot to the catalyst here, the real value of the SHIELD IDIQ contract. The market isn't just buying paper, it's buying validation. Getting selected as an awardee, it validates their entire LizzieSat architecture using 3D printing, hybrid manufacturing for what they call responsive space. It's a signal that the Missile Defense Agency sees this as a viable solution for tracking things like hypersonic threats.
Right. And the emphasis there should be on the non-monetary value, because that's exactly what the contract has delivered so far. Zero guarantee dollars. I get it. MDA clearance is a huge vote of confidence in the tech. I'm with you there. But an IDIQ contract is just a license to hunt. It guarantees no funding, no volume.
I'm sorry, I just don't buy that the potential alone justifies a 15 times TDM valuation. The risk here is all about timing and news flow. We know the market pulls future revenue forward aggressively in these situations. The SHIELD announcement was late 2025. Funded orders, they take months to materialize. A 60-day news vacuum with no actual task order, that risks a swift, violent snap back down to that institutional anchor price of 150, or at least a cap right at the 225 warrant price.
I'd acknowledge the bureaucratic lag, but you can't overstate the importance of clearing the MDA's vetting process. Unlike these new space startups, SIDU's heritage from Craig Technologies means they already have the facility clearances, the audit history, the infrastructure. They can execute immediately. That speed is exactly what the Golden Dome architecture needs, rapid deployment.
Speed is critical, yes, but so is addressing the elephant in the room, the float, and the shorting. You highlighted the technicals. That cost to borrow at 136% is, I agree, a screaming indicator of scarcity and huge risk for shorts. If good news hits, you could get a very forceful covering event.
Exactly. And the company's high beta, over 2.3, it ensures any positive news gets amplified dramatically, which just fuels that squeeze. The shorts are mathematically trapped in a high-cost position. They have to be convinced failure is imminent.
They might be trapped on short-term costs, but the idea that this is a low-float scarcity play is just, it's outdated because of the dilution. The float has expanded to about 14.5 million shares, and it's loose. And the institutions who bought in at 150, they have a very clear built-in arbitrage exit strategy.
Can you explain that arbitrage mechanism? Because I think this is where your dilution argument really has some teeth.
Sure. So these institutions, they got millions of warrants at that 225 strike price. They have a guaranteed profit if the stock is trading above that level. So, to neutralize their risk, sophisticated funds will short the existing float. We're seeing a lot of this in dark pools, about 37% of short volume. It's a hedge against their warrant exposure. They're using the new supply from the offering to constantly sell into any rally, locking in their profit between the 150 they paid and the current market price. It makes that 225 warrant strike a true economic resistance ceiling.
I'm not convinced that that supply can withstand the pressure from a real contract. The squeeze pressure, if it's fueled by unexpected news flow, could overwhelm that. I mean, the fact is, shorting at a 136% borrow rate for more than a few days is economic suicide. It signals extreme short-term scarcity, regardless of the total float.
And the cash runway gives them a year to convert that IDIQ. Time is on their side, not the shorts.
Time is exactly what they're running out of without hard news. The market only cares about that runway if it can see the funding that's going to replenish it. Let's talk about execution risk. You mentioned vertical integration, and I agree. In theory, that's a huge advantage. Manufacturing with Mark-forged printers, the on-orbit edge AI, it's all essential for Shield requirements.
That vertical integration is their core differentiator. It's how they deliver responsive space. That is cheap, fast to build, and secure. That's the whole strategy.
It's a compelling story, but what's the operational reality right now? They are deep in that valley of death. And the risk is amplified because their valuation is banking on perfect future execution against peers who are already showing stable growth. A single operational failure, a missed deadline on a LizzieSat, a failed launch, it would be catastrophic. For a microcap, that would instantly confirm the dilution trap thesis and send the stock crashing way below that 150 offering price.
But that 150 price does provide strong support. Those initial investors have deep pockets, and they're not likely to exit at a loss if they believe in the defense mandate. The fact that we're trading above $3 shows the market is willing to pay a huge premium for the option on that execution. You're valuing a high-growth space platform on its old legacy revenue. The pivot to SaaS warrants the higher multiple.
I'm valuing it based on the mathematical certainty that 10.8 million shares were printed at 150, and millions of warrants are waiting at 225. That warrant strike isn't a floor, it's a supply gate. The disconnect between the current price and their actual revenue requires constant, exceptional news flow. The second that news stops, the gravity of all those cheap shares and warrants just takes over.
And I'd argue the political capital and their position in the Space Coast ecosystem mean that news flow is likely to be more consistent than you think. When a company is this entrenched with the DoD's top programs, that technical setup, with the high borrow cost, it becomes a crucial amplifier.
But strategic mandates are still subject to budgets, reviews, and operational lag. We know that revenue recognition won't be until late 2026. The stock has to survive the next year on hype.
And the technicals suggest they have the exact dynamics, that high cost to borrow, to survive that period.
But the structural supply from the dilution will eventually overwhelm that scarcity in any long-term rally.
Well, this discussion really gets to the heart of the classic tension you see in the space. It's speculative, high-velocity government sentiment fighting against cold, hard capital structure mechanics.
Exactly. Your position is that the defense angle and the short squeeze dynamics are a powerful enough lever to just override the structural supply issues from the float expansion.
And your position, which is grounded in the financial mechanics, sees that dilution in the warrant overhang as this gravitational force that's just inevitably going to pull the stock back down toward that 150 institutional anchor, making any real rally above 225 almost impossible to sustain.
Yeah, the immediate future here is a truly binary equation. It depends entirely on the speed and the size of funded task orders from the Missile Defense Agency. Without a constant stream of high-grade news confirming that Shield IDIQ is turning into real dollars, the risks from that liquidity wall and the frankly staggering valuation disconnect will almost certainly dictate the price action.
Or conversely, that critical capital injection has given them the breathing room they needed for exactly that news flow to materialize. So we're left to weigh the power of the Golden Dome narrative and these extreme short-term technicals against the long-term math of dilution. I think understanding both sides, the technical setup with the short interest and that extreme borrow cost, and the fundamental headwinds from the warrants and hedge shares, is essential to really appreciate the complexity here.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.